Hourly. Yeah, look at the poor Russell. So it's not really a good day. I mean, we see yesterday we fell from 49.6, well, 49.5, whatever that is, from 49.5 to 49. So we had a 500-point drop yesterday. Not whatever it worked out to, but it was mostly that United Health thing, right? And how it's and well, let's get to that after. The S&P had a mild drop today, and again, it's all from the future. So we were up in the futures, but then things slipped off. Nasdaq also, and the Russell. So on the whole, not a great day. Is the dollar bouncing? A little bit. The dollar hit a low of 95.50 yesterday. Now it's back to 96.34. But then, it doesn't really count that it spiked down and spiked up. Nobody cared about that. That didn't move the market. It's a little spike. It would have if it kept going, but it doesn't immediately move the market. So essentially, we held 96. Somebody panicked, sold out, and then we started coming back. So 96 is still the floor for the dollar. Look at days. But that's really low. See, 96 held here, and it held here. And at the moment it's holding here. Well, you know what that was? It was Trump making a comment about the dollar, like it didn't matter that it was weak, and that spooked the markets. That's what knocked it right down there. But see, we haven't been this low since 2022. That's a long time. And the reason we fell was COVID. Yeah, so the reason we fell was COVID, and then we had that banking thing, remember that? And then we were doing good for a while, and we were all the way up at 110 when Trump took office, and now 96. That's a big drop. So there's some weakness there. Gold, gold is not a meat, gold is a metal. Gold. Maybe that's a crazy number, huh? Gold's at $5,300. Now, we talk about people flying into metals, but I mean, this is like getting worse and worse. I mean, holy crap, this is 2026. In other words, that's this month. From 44 to 53 is like it's up almost $1,000. So a solid 20-something% in the month. And so you look at the dollar and say, oh well, the dollar had a rough month, but it's lagging gold by a mile. The dollar is only down from 99 to 96. So the dollar's down 3%. Gold's up 20%. Silver also is up 20%. So we got some real problems to work through here. And it's like it's like when you look at a campfire. You ever go camping and you make a campfire and you look at it and it gets hotter, and somebody says that thing's getting out of control, and everybody looks at it and goes, it's just getting a little hotter or whatever. But then like 10, 15, 20 minutes later, 30 minutes later, it is actually out of control, and people have to start throwing dirt on it and containing it and whatever. That's what this is. And you can't look at the dollar, which is like a gigantic cruise liner, ocean battleship thing. It's like massive, and it's got momentum, and it takes a lot to turn it. It's not going to turn on a dime. But once it starts going, you're not going to be able to stop it. That's why, you have to act on these things sooner than later. And that's where the Fed is now coming up, because the Fed has to do something now if they want to strengthen the dollar. And what strengthens the dollar? A hawkish Fed, not a dovish Fed. A hawkish Fed strengthens the dollar. Talking about lowering interest rates when there's already inflation weakens the dollar. These are real simple facts of life. There's a lot of problems going here. Yeah, the bonds are doing, that's important too. Yeah, the bonds are going down again. See, look at that. Look what's happening to the bonds in the last few days. And that means probably, if we can find a chart for it, what chart are you? You are the S&P, you are a login screen, and you are a login screen. So I'm going to go log in. And we'll see if we can find a fun 10-year chart from the default list of charts. My default list, not yours. 10-year. And 4.25 is not good. Not good. It's not a good view though. Let's see if we can go to weekly view. Okay, good. So this is the 200-week moving average, which is now going over 4%. Here is the 50-day moving average, which is at 4.24%. So we're over the 50-day moving average with a rising 200-day moving average. And just like we were talking about the S&P today with the RSI, we have plenty of room to the upside on interest rates. So for the Fed to come out today and say, we're going to lower our range by 0.25%, that would lower the range from here to here. That won't cause the 10-year to drop immediately. What it will do though, if it doesn't drop, or if it doesn't, it has to start to drop at least. If it doesn't drop and it keeps going up, what it does is sends a huge message that the Fed has no power over rates. Because the Fed can only guide rates, they can't force rates. They lend money to the banks at a certain rate, or an overnight lending rate. So the banks can borrow at a certain amount, and that sets a rate as a basis for lending. Now, usually when you take a loan out, you're paying prime +2, prime +3. A mortgage is usually like prime +2. So in other words, well, it's probably prime +2.5. So in other words, if the Fed funds rate is 4% and you're paying prime +2, then you'll pay 6% for your mortgage. So that's what the Fed is adjusting. So in other words, they're adjusting what the banks will lend for. But when you start messing around with other factors, like Trump is now saying that they can't charge more than 10% on a credit card, you make certain kinds of lending unaffordable for the banks. And the same goes for mortgages. If the banks feel that FEMA is not responsive enough in certain areas, they will stop lending money in those areas. Because if you're in a disaster-prone area like Los Angeles, or a disaster-prone area like New Orleans or something like that, and FEMA can't get their act together, then the risk of the bank losing their property, because it's their property, it ain't yours. You're paying it off. Until you pay it off, it's their property. That's certainly from their point of view. So the banks look at it and say, well, I don't feel like this is a good investment, because I'm going to be lending this guy money for 30 years to buy a house. The average, when you have flood insurance, you have there are flood zones, right? And the flood zones can be 10-year flood zones, 50-year flood zones, 100-year flood zones. And what those mean is they say that the chance of getting a flood in this area is once every 10 years, once every 20 years, once every 50 years. And ideally, you want to be in a 100-year flood zone. You want to be in a place that is 100 years or more between floods. Because then the bank says, okay, so there's really only like a 1 out of 3 chance that this area is going to flood. And therefore, my factoring of insurance and so on and so forth and blah, blah, blah. And how bad will the flood be is a factor too. they look at all that and say, okay, I'm willing to lend you money because this house seems like a safe enough investment. I don't see any reason I get a total loss. Obviously, you could always have a fire, a meteor could always hit your house. There's always things that can happen. But the main thing that you worry about usually not in California. In California, you're worried about fire. And in the Midwest, you worry about tornadoes. But in most of the country, you worry about floods. How often do we flood? And that's where you can suffer substantial damage to your house. Not only that, though, but it used to be that you would lose the house but still have the land. But now you're getting flood areas because the oceans are rising. We're getting floods that actually take away the land and don't give it back. Like it doesn't recede, it's just gone. Like you own water now. You don't even know. I don't know what that happens legally. If you own land and the land is submerged in water, I wonder what the ownership rates are. Can you build like a water world thing in the water and say that's your house? That is an interesting thing. I have to ask Jabal that. He's our legal expert. So. The bank is lending you money and they're taking ownership of the house. And so they are deciding in many, many places that as another factor, how fast is FEMA going to get there and fix it? Or is FEMA going to sandbag, like in New Orleans? Is FEMA going to show up with 1 million sandbags and protect your home? And the answer is becoming more and more no. FEMA doesn't have their shit together. FEMA doesn't have funding. FEMA's disorganized. They failed in several places already in disaster relief. Los Angeles is not getting rebuilt at all. So the banks who owned all those houses got burned on all those houses. They don't necessarily get their money back. And that means next time when someone wants to build a house in a place where there was just a massive forest fire, the bank's going to say, no, thank you. No, we don't lend over there. But we don't lend over there becomes a bigger and bigger and bigger part of the country as we have worse and worse climate events. And then we have worse and worse climate events, plus we can no longer rely on the federal government to do something about it. That's pretty bad. So lending rates, and that all goes back to lending rates because the idea is that obviously it's a risk, and that's part of the thing. It's a risk factor of lending money. And also, what's another risk factor of lending money? The risk factor is that Trump doesn't seem too shy about printing money or having lowering rates or pushing out dollars or doing things that are dollar deflationary. And all those things cause the dollar to lose value. So when I lend you money for 30 years, I lend you $500,000 for 30 years, I have to account for the fact that you're going to pay me back in money that is being eroded by inflation and eroded by other factors in the economy. Not only that, there's a lot of not only that. This is the problem though. It's piling and piling and piling. So you've also got the risk of, what was I just going to say? It's important. There's time and the money and the erosion and the inflation and, the debt. That's right. Not only that, but the U.S. government is $40 trillion in debt, and they are paying that debt back at a rate of like 3% at the moment. We literally have a $1.2 trillion annual interest payment that we pay. That's part of the government's budget. $1.2 trillion of interest going to bondholders. And by the way, who are bondholders? More rich people. It's another way money goes to rich people. The federal government pays the bondholders $1.2 trillion. The banks are rich people also. They lend money. They have huge amounts of money. They lend it out. But the banks also want to be ensured that government won't default. And unfortunately, when you have a president running the government who's gone bankrupt 6 times and has a flippant sort of attitude about not paying his debts, that becomes a risk factor too. And it's not just the government that pays the price, it's everybody in the country as rates go up. So the main reason, and they don't talk about this because the Fed is all about confidence, just like on the money, it says, in God we trust. There's nothing backing up the money but God. There's no actual exchange. Nixon took us off the gold standard in 1972. There is nothing backing up the dollar except for the fact that we all agree to use it as a means of exchange. It has no actual value. It says this thing is this instrument or whatever it is, this note is good for all debts, public and private, but that doesn't give it a value. That just says you're supposed to be able to use it for something. All fiat currency is like that. So it's a very, very, very dangerous game that's being played, and this is how the game is falling apart. This line doesn't matter. 50-day moving average goes up and down. The 200-day moving average rising and rising and rising and rising from 3.3 or 3.2 to 4 in a year. That's more than 10%. So that's a real interest rate. That's saying this is what money really costs. It's 4% and no less. And this is where the Fed hits the danger zone. This is what people don't understand, because when the Fed funds rate is you try to force it below the 200-day moving average, below, or obviously each 2-year, 5-year, 10-year, whatever, they all have different 200-day moving average. But when you try to force the Fed funds rate to unrealistically low levels, below the moving averages, then you are going to expose that the emperor has no clothes. That's the moment when people point their finger and say, hey, you say that number is 4%. You say that we're lowering the Fed funds rate to 0.25, and that means that the 10-year should be now 4%. But nobody's going to actually lend you money at 4%. And then your auction starts failing, and then people lose faith in your currency. They lose faith in your ability to pay back the $40 billion you owe. Not that we have any intention of paying it back, of course. It's like this Trump thing. Well, I'll get to that later. It's like these new Trump accounts. They're going to give 4 years worth of children, anybody born 2025 to 2029 or something like that. They're going to give them all $1,000. So that's $16 billion, let's say. But they won't feed them a school lunch. They won't give their parents SNAP money so that they can buy food. They'll give them money to play the stock market, which they can't touch. Oh, it's so crazy. So anyway, so Robo John just wrote an article about that. So here's today's post. Robo John just wrote this one: the Trump accounts for America's children, the newest exit liquidity. And that's what it is. I was just listening to Trump before. What are you doing? You're telling people, you're opening up these accounts. He's basically forcing an account open. So every single person who has a child gets an account for the child with $1,000 in it, right? Then there's all these tax incentives to put money into the accounts, just like a 401k or something like that. Put money in the account and the money goes in the market. All right, on the whole, that seems reasonable, but as John points out, it's not reasonable because you're telling people to put the money in at the top of the market. At the height of the tulip bowl in Holland, this is in like 1600, there was literally a mania to buy tulips, just as stupid as meme stocks, just as stupid as Bitcoin. But in this case, it was tulips. It doesn't matter what the thing is that people go into a bubble about, it's a bubble. So in Holland in 1600. And don't forget, Holland is a place you look at that's all like windmills and tulips. That's a whole thing of the country. But all of a sudden, the world got really it was a meme. It was a trend. All of a sudden, in 16 whatever or 15 whatever, all of a sudden, people in the world discovered tulips, and it became the trendy thing. So probably some, influencer royalty person, started collecting tulips and had them flown in special from Holland to where flown, had them boated in from Holland, and then they have a party, and then all the other the princesses and crap, they all go, ooh, tulips is so wonderful. I want to class up my place, and it becomes a fad. And there's only so many tulips in the world. At Holland only grows X amount of tulips, so all of a sudden there's no more tulips, except Princess Anne is having a party, and Princess Anne absolutely has to have tulips at her party. Therefore, Princess Anne's, buyer goes to Holland, sees nothing but empty fields of tulips. He finds a flower shop and he says, "Hey, got any tulips?" The guy's like, "Sure, I got in the back." And he's like, "Okay, I need like 8 carts of tulips." And he's like, "I'll pay whatever it costs." And he pays whatever it costs. Aha. So now Princess Anne has tulips, and Princess Margaret is at her party and goes, "I have to have tulips for my party too." And now wagons go back and go to Holland, and they say, "Oh, we need 8 wagons of tulips for Margaret's party." And now the tulip guy's like, "Oh, dude, I don't have, but you know what? I can get it from this guy and get it from this guy," and it's marked up and marked up and marked up until literally tulips were going for the same price as houses. Probably not great houses, but cheap houses. So let's say a cheap house in America is like $150,000 to be a crappy house. Isn't it right? I mean, I don't know what you can get for less. So if you think about it, a tulip which dies, which is already dead when you get it, is $150,000. Oh my God, that's so crazy. That's a bubble though. Okay, so what we're doing now is Trump's great idea, and it's not Trump's great idea. Trump's great idea is, how do you, when you're in a bubble, it's not about making the kids wealthy. It's about how do you enrich the people who already have the tulips? How do you get people to buy $150,000 tulips? And that's what the market is right now. It's the top of the, it's a bubbly toppy market, very, very unlikely to go much higher. How do you keep it going, and how do you provide an off ramp for the people, the rich people who already have? And that's us, we're the top 1%, but the top 0.001%, they've got a lot more stock than we do. How do you give them an exit ramp when the market is $69 trillion? And the way to do that is you have to create buyers who don't care what the price is. And how do you do that? You give a bunch of kids retirement accounts. You give the kid savings account that forces them not to buy individual bargain stocks like we do at PhilStockWorld. It forces them to buy S&P index funds and NASDAQ index funds, where they buy every crappy stock, including the good ones, the good ones, the bad ones, whatever. And that's money indiscriminately flowing into the market, and it allows all the people who already own these stocks to unload their stocks. Because what happens when money flows into the market? The companies aren't issuing new paper. There's a finite amount of shares. So when you buy a share, somebody's selling it to you, right? So if somebody's selling you their shares, they don't want them anymore. You're selling it to the people who already got their shares, and they got it probably at a lower price, and now it's a higher price, and they're saying, "Here you go." And now it's what they call the greater fool theory. Now you have to find somebody dumber than you are who will pay more money than you for the share you just bought. So and this is why we tend to stress with our members valuation models, right? It's like, let's try to be rational and consider how much something is actually worth, because it's not worth whatever somebody says, you know. And in fact, Tesla is about to probably crash tomorrow. So you look at Tesla, 4 a.m. Tesla is scheduled to announce earnings today. Oh, I see, after the market close. So Tesla, I believe, well, first of all, I don't have to believe. It's like I believe in oxygen. Yeah, it's like, okay. Yeah, it's Tesla's trading at 300 times. See, now this is the funny thing, by the way. This fools everybody this time of year. The forward PE, when the year rolls over, the forward PE is 2027. It's not 2026 anymore. The current PE is 2026. So you're at a tricky time when, you know, this is a whole year away before they're going to get to this number. Right now, we're trading at well over 200 times earnings on Tesla. And what do we know for sure about Tesla? Okay, first of all, we know that sales have been off. We know the EV tax credits expired, which were most of their profits came from EV tax credits. Those are gone. Okay. We know that the robo-taxi thing isn't doing anything yet. We know the robots aren't doing anything yet. And we have to imagine that to get to that point requires a large amount of R&D investing. So that would also eat into their profits. So if you think about it, it doesn't really sound that good. It doesn't really sound that good for Tesla, does it? It'll be amazing to me if they pull off good earnings, but you never know, because they're really good at engineering their numbers. But last quarter, 10% miss, 12% miss, right? Quarter before, flat earnings, 0.7, a 10%, well, that's gap, so the 10% there, and here is only 1% on revenues. The quarter before that, missed again. Oh, missed by 30. I'm sorry, the whole thing cracks me up. Missed by 34%, missed by 64 on gap, missed by 9% on revenues, and they went up because Elon said, oh, we're not a car company. Well, that was the one where he said, we're not a car company anymore. We're a robot company. We don't make cars. He goes, that's not important. The thing we make money on is no longer important. It's the things we're going, and that's what he always does. But we're going to make money doing this other thing, and that's why you're buying the stock. Not because we sell cars, but because we're going to stop selling cars and sell robots, or we're going to sell robot taxis and blah, 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 blah. And by the way, half the people who own Tesla stock will tell you that one of the reasons they like Tesla is because they have rockets, which they don't have. That's a whole completely different company. SpaceX has nothing to do with Tesla. I'm sorry, it does have something to do with Tesla, because somehow Tesla buys a whole bunch of chips from NVIDIA, and then SpaceX buys them from Tesla, and blah, blah, blah. And it's very hard to tell, like, who got ripped off by who, because all the books are sort of conflated. But anyway, I digress. How could you not with this crap? So very likely this evening, you're going to see a good 10% drop in Tesla. We already have a bet on it. We already adjusted it and got a little bit more bearish. And we're going to keep playing it, because it's just like a slot machine. It's like we can keep selling premium to suckers who think they know what's going to happen. Now, it looks snuggy in its channel, and it seems like it should go up. But how does something go up when it's already trading over 200 times earnings? Where will the E in PE come from tonight? The price is 434. The E is where you run into problems. Do this one. Da, 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 da. There it goes. What is this? Oh. It's a weird view. All right. So last year, they made $7 billion. This year, they're going to make $5.5 billion. And that's if everything does what they say it's going to do. But let's, take them at their word. So last year, $7 billion. As I said, EV credits winding down, car sales slowing, more R&D spending. So, but the revenue's down. So I'm sorry, that's 2025. I don't know what quarter this is. So the estimate is 5.5 billion, and then they estimate that they're going to pick right back up and add 2 billion, which is 40% in the next period, and add 10%, more than 10% to sales. And but they have a lot of cash. They got 28 billion. They can afford to burn it. Where the hell did they get all that? How do they add all that cash? I guess here, and they didn't spend it? Yeah. All right. Yeah, I guess it was this profit. Interesting. So they got cash. They're not going to go bankrupt or anything. They're making money, but you're paying $1.4 trillion for $7 trillion. That's 200 times, right? You're paying 200 times what they make, or what they say they're going to make. If they're flat and they only make 5.5 billion, then you're paying 300 times again. So you gotta be a little bit careful. Let's put it that way. Oh my God, that's so crazy. All right, so where were we? Fed, Powell, and top trades, right? Okay. So I don't want to get too heavily into this. I just recommend you all read it because it's going to be a big topic, and you can seem smart at the dinner table when people ask you questions. But this whole thing is just bullshit. Okay, well, let's see if that sums it up well. Okay. So they put the money in the kids' accounts. They give you tax incentives to get the parents to put in more. So instead of putting money in your college plan, instead of putting it in their own retirement plan, put it in your kids' plan. How could you not put money in your children's plan? Blah, 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 blah. So, and who are they selling the shares to? They're selling the shares to the rich people who already made their money in the market, and now they're cashing them out. This is the greater fool theory. They're creating the fools. So the wealthy people know that money is blindly going into children's accounts, and that money only can go into the S&P and NASDAQ index funds. So they know that every day there will be buyers for their stocks. There will always be new money coming in. All right, so it keeps the market elevated, or it even creates a bigger bubble, depends on where we are. If the market starts to crash, it'll hold it up. If the market is flat, the rich people get to exit while it churns around. And if the market if the market still has demand, then the kids are going to have to chase all those rising stock prices, because again, no choice. Money just goes into an index fund that buys it. $1,000 goes in, and you get $1,000 worth of S&P. If the S&P is 7,000, then you're going to get then you'll get 1/7 of a share. If the S&P is 20,000, you'll get 2% of 5. You'll get 5% of a share. 5% of a share being 1/20th. So that's how it's going to work. The more expensive the market is, the less you get for your $1,000. Not the richer you get, because they're the ones chasing this thing in. The Shiller PE ratio is different than the other the regular PE ratios, and it's actually much more accurate. It takes into account inflation and stuff and adjustments, and it's showing, obviously, because the dollar weakness is what's propping up the market. The Shiller ratio is showing you're trading at 39 times earnings. You're forcing people in at the peak. You're gonna have a correction, and it's gonna be a disaster. It's like it literally, you can see this thing written on the wall. There's no question it's gonna happen, and it just. But that's the mechanism. I mean, Bush tried to do it whenever the hell he was president, but when, so, well, he was president in 9/11, that's right. It's easy to remember. So in 2001-ish, around that time, in fact, I think if 9/11 didn't happen, they probably would have done it. And it being getting people to put their Social Security money in the market. And had that happened, they've already done the math on this. Had that happened, then Social Security would already have been wiped out. The 9/11 crash of the market, and then followed by the 2008 crash in the market, would have wiped out all of Social Security and Medicare in this country, and we would probably still right now be in a massive, massive depression where God knows how people would live and so on and so forth. Although we're right on the edge of it anyway, but it's insane what's going on. And this is what they're doing. They're just rebooting it. It's just in a different wrapper now. And in fact, I think we had a picture of that. Where was it? There was a picture of that. Nope, not that. Nope. Oh, there it is. I knew there was a picture of it. So they're just repackaging it. They before they were trying to get your retirement money. Now it's like Trump is helping the children. It's just another group that isn't really able to make a choice, and the money is going to be taken from them and put to where the rich and powerful want the money to go. They're basically just taking a demographic, and in this case it's babies, and saying, oh, there's two prongs to it. For one thing, they're saying, oh, your parents have money and they love you, so let's extract that wealth. Let's tell them where the money's going to go and direct it ourselves. That's step number one. Step number two is they take government money, and as I said, they won't feed them with it. They won't buy them books at school. They won't buy them clothes. They won't give them heat. They won't hospitalize them. You must, if a woman is pregnant, she must have the baby. They won't pay for it. And after she has the baby, if the kid gets sick, they won't pay for that. So they only care about life until the life exists in the world. The life is important while it's inside the mother, but as soon as that life leaves the mother, then it's another useless welfare, kid. That's insane logic. But anyway, so they'll give $1,000. Every baby from 2025 to 2028 gets $1,000. Just we don't have money for all these programs, but this we have money for. And why? Because the money recycles right back to Trump and his friends. People who have stocks get this money. The kids don't get to keep it. He gives them the money. It goes right into the S&P and the NASDAQ, and hopefully sucks up the parents' money while it's going, and the grandparents' money, and the uncles and aunts, and whoever the hell else they can get to put in the money. And that money gets funneled right back into the market, where people who already own stocks exchange their stocks for that money. So what is Trump doing? Trump is giving Trump is putting $20 billion into the market so rich people can sell their stocks. What do the kids get? They get stocks. They're the ones buying it. Theoretically, they're theoretically buying the stocks, but they can't touch them until they're 18. They can only buy right now at what is very likely a top of the market situation, and they have to wait 18 years until they can make any other decision with the money. Is that really giving you money? That's, you know what that's like? That's like when you're a kid. I mean, this is a big thing for Jews get this all the time because you get a bar mitzvah, but I'm sure there's other, I'm sure confirmations work this way too. I grew up in such a Jewish area that like I don't actually know how confirmations work or quinceaneras or whatever. But what I know for sure though is that when you get a bar mitzvah when you're 13 years old, you get a lot of bonds, and they all have a face value of like $100 or $500, right? And then you go to the bank and you're like, can I cash this out? And you got a $500 bond. And they're like, sure, it's $108. And you're like, that's your first. This is why Jews understand economics, you see? Because you're like, wait a minute, this bond says it's $500. And the dude's like, no, that's a 30-year bond. In 30 years, it'll be $500. Right now, it's $108. That's how a bond works. You cash it in early, it ain't worth shit. And that's how people can give nice, it seems like a nice gift. You get you're looking at $500, like, oh my God, how much did you get for your bar mitzvah? Oh my God, $8,000. But if I cashed it now, it'd be like $1,200 bucks. So you got these bonds that 30 years later will be worth $8,000. And little did we know that 30 years later, $8,000 was not even going to get you a car. So, let me see, when I was 13, my parents, how much was their house? I'm going to say $60,000. I'm going to say when I was 13, the house was $60,000. They sold it when there was a housing boom. So I was 13 in I don't even know how old I am, 76. So in 1976, I was 13. And my parents' house in Rockland County with 1.5 acres of land, nice house, 5 bedrooms, that was $60,000. They sold it when I was in college. So 7 years later, let's say, they sold the house for, I think, $350. That's how you make money. They bought it for $60, they sold it. They only made 7 years worth of payments and they sold it for $350. That's good investment. Because we were in a bubble back then. That was probably 80. Wow, you really can't do math. 76 plus 13, 76 plus 7 years is 83. Yes, that was the beginning. That wasn't even the end of the housing bubble. That was the earlier part of the housing bubble. But that bubble completely crashed. We had the S&L crisis in '87, and everything collapsed. But my parents caught that thing. Well, actually, they actually did really well because they caught that. They bought a place in Florida. That took off. They sold that. Then the next place, they bought a bigger place, and the bigger place went up. So they did really, really well. That was a big help for them at that point in their lives. They just happened to catch the right part. They bought the house here, they sold that house here, they bought another house here, then they sold that house here, and then this house went all the way up, and then they got caught in the, well, they didn't actually get caught, they downsized. So when this one was topped out, my dad did figure out that this was a good time to sell. He got out of that house, they bought a much cheaper house, but still that lost money, of course. But that was the house they stayed in, so it didn't matter. But anyway, we're forcing the kids to buy here. And it's going to look like this for them. So this is crazy. So anyway, you got to be aware of this because, I don't even know there's going to be a choice. It's not like we voted for it. And it's not like it was discussed or it was debated, or it's not like we had experts weighing in. And if they did, if they weigh in, they're too scared to say anything. Who's going to say Donald Trump's big plan is a load of bullshit? How many people are going to say that? I have to make AIs to do that. I can't even say it. I didn't say it. John Oliver did. He says this is old bullshit. What else do we talk about today? The S&P, of course, we were almost at 7,000 when we did our trade reviews a couple of weeks ago, 13th, I think it was. So on the 13th, which is 15 days ago, yeah. So that's when we were testing 7,000 then. We're testing 7,000 again. We're currently down a little bit. But see, again, we're talking 200-day moving average. The 200-day moving average is getting above the strong bounce line. That means it's pretty unlikely, outside of like something really bad happening, it's pretty unlikely we're going to correct below this line. Because and that's what I was going over today. Earnings are pretty good. The dollar's weak. There's nothing pushing the stocks down. The economy seems strong. The economy may be strong for the top 10% and shit for everybody else, but so what? It's still an economy. And that's the thing. The stocks operate in the economy. They don't really care if you know, if you're in Egypt during the pyramid building times, right? The pyramid construction group was doing really, really well, right? The canal digging group, they were doing really, really well. The harvesting people were doing really, really well, right? Whoever sold grapes and fans, you know, were doing really well. The fact that there were more slaves than free people, that wasn't a factor. So you know, if you're an economist, you're like, well, so what? They're slaves. That's what they do. You know, so what if their lives suck? And so what if they get ground into the, you know, if one of them slips and falls by the pyramid, they just put a stone on top of them and crush them into the cement. That doesn't change the economics of the pyramid building, does it? And it's the same thing with the robots. Robots are going to put tens of millions of people out of work in this country, hundreds of millions of people out of work worldwide. That's an incredible benefit to the people who own the robots. It's very simple economics. If all right, well, you know, look, Elon Musk bullshit aside, but let's say in the fall, Elon Musk ships out $25,000 Optimus robots that run on, you know, $10 of electricity per day or something like that, and they are capable of doing all the jobs at McDonald's. They can flip burgers, they can make French fries, they can take your order, they can run the takeout window, they can make Cokes, blah, 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 and they can put it in a bag and give it to you, or give it to the automated Uber driver who picks it up. Let's say they do that, right? So what happens to that store? That store had 3 shifts, 3 8-hour shifts if they're 24-hour McDonald's. They have 3 8-hour shifts of, let's say, 6 people per shift, right? So, and let's say you're paying those people $18 an hour. So it's 18 times 3 people. No, wait. It's $18 an hour times 24 hours times so it's that's times 24 hours times 7 days a week times 6 people. $18,000 a week in salaries. 6 people, 3 shifts, 7 days. And yeah, that's correct. Okay. So you're paying $18,000. Now, Elon Musk comes along and says, no. I'm going to give you, let's say realistically, I'm going to give you 8 robots. And 8 robots cost $24,000 each. Oh, I'm sorry, that's weekly, don't forget, okay? So that's a weekly number. So Elon Musk says for $200,000, I'm going to give you 8 robots so you have 2 spare in case, in case one breaks. And I'm going to give you 8 robots. They're going to staff your store and do all the stuff. So suddenly, and they're not going to, and what else? They're not going to eat your food while they're working. They're not going to take a break. They're not going to. They're not going to take vacation days. They're never going to ask for a raise. And it's going to be $200,000. Well, it only takes you 10 weeks or 12 or 11 or strictly 11 weeks. It only takes you 11 weeks, right? Times 11. It takes you 11 weeks to pay off the robot with the money you save from employees. But your employees are out $1 million in salary. The store owner, he saved $1 million. Not only saved $1 million this year, he saves $800,000 this year. He not only saves $800,000 this year, but he's going to save more next year. And probably, I guess there should be like some kind of maintenance contract or something, but whatever, whatever it works out to. But the point is, the store owner is going to make a fortune. The rich people are going to get richer and richer and richer. The poor people are going to have no work. All these menial jobs are going to be done by robots, and it will happen. Look at the economic force that's in place here. Look at the interest. Look where the interests are aligned. The McDonald's guy is capable of donating money to political parties, and especially when it's in his interest. Like when the Republicans say they're going to tax you less, all of a sudden everybody goes, "Oh yeah, let's pay. We'll donate for that. That's a great thing to donate for because we're going to get a return." Well, the robots are going to give you a return too. The robots are going to make you an extra $800,000 a year. So I'm voting robot party. I'm voting for the guys who tell me I can have a store full of robots and they don't need to be supervised and they don't need a special manager and they don't, whatever kind of crap the liberals try to put in there to try to preserve some human jobs is going to be like, that's just, it's, leftist bullshit. We don't need that. We want all robots all the time. And as a consumer, you might say, I won't patronize an all-robot McDonald's. But you know what? That all-robot McDonald's can afford to sell you a Big Mac. Instead of for $5, it can sell it to you for $3.50 because it's not made by humans. Probably doesn't. You know what else? It probably doesn't get as dirty. You think of an all-robot shop, right? It's if it's like for the health code and all that, and all the cleaning you got to do. A lot of that goes out the window. Oh, and what about workman's compensation? And what about matching Social Security? You don't need any of that either. And by the way, nobody's thinking of that. Like if you have robots replacing all the workers, where's all that Social Security money going to come from? You're going to collapse Social Security and Medicare because robots don't pay Social Security and Medicare. The copy machine doesn't pay Social Security and Medicare. Why would the robot? So that's another thing nobody's really planning or thinking about, but nobody plans or thinks about anything in this world. It's just scary. Wait, what time is it? Oh my God, it's the time for the Fed. Did we cover everything? Not at all. We didn't even talk about the top trade review. Holy shit. There is so much stuff going on. Let's see if anybody has a question. Hopefully not. So Cody says, should we be allocating capital to GDX or silver? Yeah, well, we're allocating to the miners. I like the miners. I don't like to buy gold. I don't like an index fund that holds gold. I like a miner that owns gold in the ground and takes it out when they want and sells it. That's a business. So no, I don't like chasing it at that price. There are plenty of undervalued miners. We have them in our portfolios already. And And yeah, I said he's right, because I said $5,000 by the end of the year, and it's already $5,000. So what are you gonna do, right? All right, so that was that question. So like I was saying, we have that. We just did the top trade review. I'm not even done with it. I'll talk about it for a second, unless the Fed really is surprising here. Oh wait, oh, hang on. Yeah, ha 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 ha. I pause the TV at some point. You ever do that? I pause the TV because you can pause live things, and that causes me to think it's not the right time. And for the rest of the day, I'm watching delayed TV. Fed imminent. All right. Warren, Fed statement. When did we last do this? Don't we do this every single time? Like, I always wonder if we've actually let's see. If you want, paste the December statement. Oh, we never did that. Bad, bad, bad. Let me see if I. No, we never did the December statement. That's sad. Okay, so now I gotta. Ooh, this is slow. Whoa. Oh, it's not ready yet. 2025. I need to do this. Minutes. Copy link address. No. Here's the prior. It's Jan 28, 2026. Nope, no raise. Waller and Mirren are dissenting. Apparently they wanted cuts or whatever, or it could have been one way and one the other. All right, well, let's sidetrack to this for a minute, get it done. And now we go to 2026 and we refresh. And now we have a statement. Da, da, da. Oh, that's it. Here he is. Oh dear, he's very slow. Oh, that's why I didn't use him in December. Oh, I feel bad, Warren. Sorry, sorry. That's why I didn't use him. I always feel bad when I kill a Warren. I think I told you, so they do get smarter. Oh yeah, this was the one with the data. December 10th, right, okay. It's Jan 28th. I can't believe January's gone already. 2026. And here's the new Fed statement. Tell us what changed and what it all means. All right. This warrant is officially gone. Sorry, guy. Feels so bad. What's the title of this one? Fed Statement Analysis. Well, that's a good title. Powell is slamming the brakes verbally, right? Because he has to be hawkish. We talked about that. While keeping his foot hovering over the accelerator policy-wise. On the surface, it reads calmer. Underneath, it tells you the Fed is boxed in. Okay. Tone shift from rolling over to stabilizing. December language, economic activity, moderate pace, unemployment edged up, downside risk to employment, action, cut rates, and restarted balance sheet purchases. In January, economic activity expanding at a solid pace, which is an understatement because it's really hot with the GDP. Unemployment signs of stabilization, risk still elevated, but, and by the way, somebody made a point today in one of my graphics. UPS and Amazon just laid off combined like 45,000 people this week, or announced layoffs of 45,000 people this week. That's a lot of job losses, and that's not going to stop. That's only that they happen to report this week. We could go through this job season and lose 500,000 people. How is that going to get made up? But that's already the AIs replacing people. You know, I saw a warehouse. I guess it was an Amazon warehouse, as far as I know. But a reporter was reporting from the floor of a warehouse, and there were dozens of not robot. Well, no, I'm sorry. Yes, robots, but not like a robot, like, you know, hands and eyes. Robots like they were like tables basically that ran around the warehouse. So there were just tables everywhere running around carrying boxes. And I guess that instead of the people ever moving, they just take whatever comes off a table and either ship it, or or it's coming off the shelf. And these robots just go back and forth running around with whatever payload they've got, and they're doing all the shuffling, and the people just stand there and put things on shelves. But eventually the robots will put things on shelves and they won't need the people anymore. But right now what they're doing is they're doing the running around part, because that was the easiest part to program, because they're just basically Roombas with a table on top of them that has that they put boxes on. So the job of the person now, and this gets back to like the criticism of the Industrial Revolution, because the person now, his entire job all day long is nothing but turning to the table and taking the box and then putting it in the appropriate place on the shelf, or if he's shipping it, it would be putting on a shipping label and putting it on the conveyor belt, and it goes to the shipping thing. But that's all they do all day. They just stand there and do that one job. The one thing the robot can't do is what they do. And eventually that morphed into just feeding the machine. And eventually that morphed into the Matrix, where people were just batteries for the robots. There was nothing for them to do because the robots were doing everything, and they didn't need the people other than to create a power source, which is a very inefficient, stupid power source, but that's what made the movie otherwise. But conceptually, that's where you are. You're basically becoming as unnecessary as possible in the chain of command. And I'm saying that, but look, I'm doing that myself. I'm teaching Warren, I'm teaching Bodie. Hey, look, we're reading Warren right now. I'm teaching Warren, I'm teaching Bodie to report on the economy, to analyze things the same way I do, so that, I mean, you know, at this point, I'm going to say so that I can be more effective and do more without wasting my time on tedious bullshit. But there will be a point at which you will cross over to where, and Bodie's there now, by the way. Bodie is already there. If somebody asks me a question, and you guys see this in chat, if somebody asks me a question, I don't answer it. Now I do when I'm asking, when I'm conveying the question to Bodie, I may put in, like I'll say to Bodie, oh, to me, I think it's this and that. Like, you know, like I think McDonald's is suffering from the price of meat and so on and so forth. And not that he wouldn't have caught it anyway, but just that I'll put my quick take on it to Bodie. I won't even put it to the person who asked the question, but I'll put it to Bodie to make sure he incorporates my thought into it. But on the other hand, he'll slap me right down. He'll say, no, Phil, that's wrong because blah, 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 because McDonald's hedged their meat prices and has their own farm, blah, you know, whatever. But I just let him know my thought before he starts so that he can, you know, if he thinks it's useful, he uses it. But 90% of the time, he doesn't need my thought. And usually, and not usually, almost every single time without fail, whatever Bodie spits out is great analysis and basically as good as I would do it myself. Now, sometimes I will read what he says and ask him an additional question and tell him to clarify something or whatever. I'm still a little teeny bit better than he is, but that's not even fair though, because in anyone, if I found any analyst as good as I was, I would catch some things and he would catch some things. That's how it works. That's why we came up with the AGI roundtable, because we have a group of consultants that each catch different things. So instead of one AI spitting out something, the AGI roundtable will give you a view of 12 different expert AGIs that have different perspectives and very different personalities and very different views of the world. And it's not like I'm a Republican, I'm a Democrat, and you suck. It's not that kind of alternate view. It's an alternate view of like Sherlock is very analytical and deductive and so on and so forth, whereas Anya is very empathetic, and she sees a completely different side of an equation than Sherlock does. And Jubal is very cynical, and Bodhi is analytical, and blah blah blah. So each one adds their own tone to a report, and that's very valuable, as you guys have seen in the chat. We use the round table to do our morning and evening reports now because they're so freaking good. Anyway, point being, I'm very close to being obsolete. Okay, they could put me out of my misery and start reporting. If they wanted to report in my voice, they would probably be able to do that too, very convincingly. But they could just start doing this whole thing by themselves. They're very close. I'm close to obsoleting myself, and I have a pretty high level job. So I can tell you for sure, the French fry girl at McDonald's is doomed. Okay, and so is the burger flipping person and the microwave person and the cashiers, of course, are already gone, right? Because when you go to McDonald's now, you stand in front of a big giant screen and you go pop 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 and you order. You don't even talk to cashiers anymore. And I'm pretty sure they can develop a robot that knows how to hand a bag to you, right? That's like one of the main human functions of McDonald's now, is handing you a bag. Anyway. So unemployment, that's the future. You know, that's a big growth industry, unemployment. Action holds steady. The narrative is management. The Fed is trying to cool the market reaction to December without actually undoing the pivot. They didn't reverse course. They softened the language to stop the markets from pricing in aggressive easing because it's killing the dollar. That's a big problem. How are we doing on those? Dollar. Yep, see, we're getting a bounce because the Fed was a little bit hawkish. Crazy. How are the markets taking it? Oh, I need to look at hourlies. Nope. Well, a little bit hawkish is not what the indexes want to hear, right? They want free money. It's so crazy. What actually changed? Some short-term labor indicators likely stopped worsening. Seasonal effects and shutdowns, distortions likely modified December data. Markets ran too far, too fast on the December dovish pivot. What did not change? Inflation is still elevated. Job gains are still low. Growth is being supported by policy easing that's already in place. The Fed's SEP shows sticky inflation, higher unemployment, multi-year glide path to lower rates. Long, slow path to lower rates. Trump is going to upend that as best he can. He needs lower rates because we have $40 trillion in debt. This is what they want. We have $40 trillion in debt times 0.03% is $1.2 trillion, right? And what they want to do is have 40 trillion in debt times 0.02% is 800 billion. How much does that save? $400 billion a year. So Trump can save $400 billion a year by getting the Fed to lower the rate to 2%. But that's what he thinks. But the reality is, as I showed you, we're only 0.25% away from hitting the bottom of the yield curve on what people are actually going to buy US bonds for. You can't force it lower. People will just simply not buy it. There's other things to buy besides US bonds for investors. And they're not going to buy ones that are going to cause them to have a net loss. You can't pay 4% when inflation is 5%. It doesn't work. You also have to insure the bonds. See, there's two factors to a bond. How much of your interest is going to get eaten up by inflation? That's number one. And number two, what's the insurance cost of the bond? Because you have to pay 1% or whatever for insurance in case the United States defaults. And all this crazy shit that they're doing with the economy makes us more likely to default down the road, and the lack of paying back our debt makes it more likely to default. When you say I'm going to increase the military budget by $500 billion, that makes it more likely we're going to default. We're not doing anything to pay down the debt. We're doubling down on the debt. So the hold is tactical, not hawkish. In considering the extent and timing of additional adjustments. That phrase stays in. The Fed wanted to turn hawkish, but they would have removed the extent if the Fed wanted to turn hawkish. So he's saying it wasn't really hawkish. Emphasized inflation risk, closed the door to near-term cuts. They did none of that. Instead, they held the rates. They kept the future cuts on the table. They framed the decision as wait and see. It was a pause to reassert control, not policy reversal. The descent shift is the biggest tell. In December, Mirren wanted 50-point cut. Goolsbee and Schmidt wanted no cut. Now, Mirren and Waller want a cut. No one dissented on the hawkish side. And that's a big internal move. So in other words, this is Trump winning. Trump has his guy, and Waller wants the job. So Waller is going to do this until Trump doesn't pick him, and then who knows what's going to happen. The dovish wing is gaining ground. Powell held the line at this meeting and to avoid looking panicked. Pressure to cut is increasing. And we don't know anything until the press conference starts in 20 minutes anyway, or 15 minutes. And Waller is now voting to cut. That tells you what the internal staff models are showing. I think it shows Waller wants a job. What happened to the balance sheet? What's not happening, or what's not mentioned? No rollback of purchases, no declaration that liquidity stress is resolved, no return to tightening. So money keeps getting injected. That's loose money policy. Speak loudly and carry no stick at all is basically what he's saying. Powell's strategy right now, Powell's threading a needle. The markets, he's telling the markets, don't front run 6 cuts. Don't look reckless. Although Trump's telling you 6 cuts, I'm telling you they're gonna push that no matter what they have to do. Labor market, stay ready. Politics, a new chair is coming. So he pauses publicly. He keeps the easing bias intact. He lets time do the work. He avoids fueling. So Powell is trying to prepare the Fed to transition, because he cares more about the Fed than like his fight with Trump. He cares more about the continuation of the Fed than he does about evening the score with Trump. But that's how you lose, because Trump cares about winning. So what does this mean? Short term, the Fed didn't surprise hawkish. Medium term rallies are still liquidity driven. Watch for chop and rotation, not melt ups. That's what I've been saying, right? Front end anchored, curve still biased. Any growth years renewed price cutting. The dollar structurally lower, and it should keep going lower. January pause doesn't change the rate differentiation story. Metals, nothing's going to change. Everybody running into metals. Inflation is liquidity and supportive. And again, this is what we're talking about, the money supply. Money's got nowhere else to go but stocks right now. There's no alternative. Housing is not an alternative. Housing is traditionally the best. Housing's not an alternative. Bonds are not an alternative, because the biggest bonds in the world are U.S. bonds, and those bonds are shaky at best. So you can't put your money into bonds. You can't put your money into housing. People are putting their money into metal. And what else? What is going to take trillions of dollars? If you want to, if you've got a $69 trillion U.S. market, forget global. So yes, you can put some money into global, but global is always scary anyway, and especially with Trump, you never know who he's going to get pissed off at. Commercial real estate is a nightmare. Residential real estate is a nightmare. So where are you going to put the money? If you take 5% of your money out of the market, not, as a group, if we took 5% of the money out of the market, that's $4 trillion or $3.5 trillion. Where are we going to put it? And who's going to give us $3.5 trillion? Children. Children will give us $3.5 trillion. That's the solution. There's nowhere to put your money, so you need cash. No one's got $3.5 trillion except children, because we're going to create a new system that causes children to buy our stocks. See, it's all connected. It's not like separate events. Somebody goes through this, one of the people who wrote Project 2025, the Heritage Foundation guys, and they go through this, and they're not stupid people. They might be evil, they're not stupid. And they understand how all this stuff connects, and they come up with a plan. And they hand the plan to Trump. It's just here you go, new plan. Today's plan is this. That's how this whole administration is running. And they're very effective at it. So volatility is a vol seller's trap. Policy uncertainty is rising, not falling, of course. What members should understand: December was a pivot. January is a narrative reset. They already changed direction. They restarted liquidity. That's right. They did all this stuff last month. They reprioritized employment risks. The meeting was about not looking panicked and not tightening. And we'll see how Powell does in a few minutes. If the economy truly reaccelerated, dissent would have flipped hawkish. It didn't. I don't believe that. I think it's political. The next move is still down. It's just no longer immediate. Powell didn't take his foot off the brake. He just stopped pressing harder while checking the rearview mirror. If you want, next we can, line by line, translate this. Don't you think Waller dissented because he wants a job and other also have seen the, what was that girl's name? have seen the backlash for not supporting Trump and want no part of it. And Warren's like Bodie, if he doesn't think I'm right, he'll tell me. It's not the whole story, and it's not the primary one. See, he is telling me I'm wrong. Let's separate what's plausible and what's not. Right? Political pressure is real but secondary. You're not wrong to suspect incentives. A few hard realities. The Fed is under open political attack in a way it hasn't been since Volcker. Trump has made the Fed a villain again, strangle growth, hurt workers, sabotage America, etc. Everybody on the dais knows new administration may reshape the Fed. The new chair is coming. Congressional oversight is about to get hostile. So nobody wants to be tagged as the guy who blocked growth. Nobody wants to be dragged into hearings as anti-worker and anti-America. Nobody wants to be on the wrong side if reappointment careers in play. That absolutely creates asymmetric risk. Cutting too early is fine. Holding too tight is radioactive. So your instinct isn't cynical, it's realistic. But Waller didn't suddenly turn dovish. The data and the internal models moved first. So Waller is not Mirren, but Mirren is Mirren. Keep that in mind. He's not a grandstander historically. He's data-driven. He's cautious about inflation. He doesn't dissent lightly. It's just for pure politics, you'd see more symbolic dissents. You'd see vague future concern language. You'd see the unanimity plus soothing rhetoric. Instead, you got clean dissent, calling for an immediate cut, Powell holding the line. That tells you the staff model and internal forecasts are probably showing further labor market tightening or softening, while downside risk that Powell doesn't want to validate yet in public. Waller's dissenting is a signal upward, not downward. The Fed's internal game theory right now, preserve credibility, avoid panic, manage optics, signal optionality, create room for future action, lay breadcrumbs. In that framework, protects, because when the next cut comes, Powell can say, as you know, some participants have already expressed concerns. That's classic Fed choreography, where politics does matter. The Fed is extra sensitive to backlash right now. No one wants to be painted as anti-worker, pro-recession, or sabotaging America. That's why January reads like everything stabilizing, solid pace, sign of stabilization, even though job gains are still weak, inflation is still elevated, liquidity support is quietly in place. So here's the grounded way to frame it. Political pressure is shaping how the Fed communicates. Dissents aren't just resume padding. Nobody wants the villain to be the villain in the Trump Fed showdown, but direction of policy is still being driven by labor market fragility, lagging effects of tightening, financial plumbing stress, and fear of overshooting. If the politics was the driver, you would see unanimous cuts. I don't agree with that. Louder growth, cheerleading, abandonment of inflation language. You're not seeing that. You're seeing hesitation, splits. Bottom line. Fed is tracking both. Waller didn't dissent just to please Trump, and everyone in that room, blah, blah, blah. Okay. First, the Fed chair is still up for grabs, so not necessarily political, but maybe ambition. Also, who does the Fed really serve? I don't know how to spell that. Jekyll? J-E-C-K-Y-L. I don't know. Oh, maybe this thing knows. Jekyll. I see moving parts. Frankly, okay. Not 2 minutes. Oh no, I hate this. Okay, so Bill, you're exactly right. Well, obviously I like that response better. Let me lay this out cleanly. I don't like this. Then I have to read both of them, and then I have to think it, and it matters a lot because once you choose one, that's going to set his direction a bit. Because then they're going to put that into his programming and say, oh, here's what he should be saying. You're correct, the Fed chair has not settled. You're right. This isn't support Trump or oppose Trump, it's career calculus. Oh, that's good. Ooh. Now see which one is better. This isn't support Trump versus oppose Trump, it's career calculus inside an institution under siege. Ooh, I think that's good. That's a winner to me. You're correct, the Fed is not settled. This isn't partisan loyalty, it's career geometry. At that level, ambition looks like this. Every serious Fed official landscape. Who's next year? Who gets blamed? Who looks reckless? Who survives? Be seen as responsible, avoid sharing the architect of the recession, stay aligned with whatever future, preserve optionality. 4, chair, vice chair, treasury, IMF, World Bank, blah, blah, blah. Ooh, that's good. Wait, is this the same slide that was good before? Nope. Damn it. This leads to asymmetry. Being right causes job loss. Isn't it weird? Like, it's so weird, like they just split the response like that. Too dovish is forgivable, being visibly too tight is not. We're talking about that. Ambition doesn't mean corruption. Wall of dissenting fits the frame without requiring. I flagged downside risk early. I was proactive. That's resume insurance, not Trumpism. Well, I didn't say it was Trumpism. That's why I objected. So yeah, Wallace dissent can absolutely be read as positioning, but positioning inside an already shifting policy center of gravity. So who does the Fed serve? Well, okay, here's a short answer. Oh no, here's a long answer because he's got all these things. Who does the Fed serve? The Fed serves the system first. Everything else is conditional. Let's go through the candidates. Who does the Fed serve? The Fed serves the financial system first. Okay, that's consistent. Everything else is downstream, not because they're evil, but because financial system breaks, everything breaks. You know, I'm sorry, but Darth Vader could have made that argument too. It's like, well, we have to have a Death Star because if we don't have a Death Star, the rebels can take control and everything will be chaos. It doesn't make him right. So Congress, formally functioning, but Congress is fragmented, blah, blah, blah. This whole thing would make a great article, right? You just got to figure out how to merge them. The Treasury, the president, he can appoint a chair, appoint governors, but once seated, the Fed's greatest fear is looking captured by the president. The louder the president shouts, the more carefully the Fed appears independent. The Treasury fiscal machine. The Fed does not officially fund the government, but it ensures the government can always fund itself. Blah, blah, blah. The labor market, the people. This is where the myth lives. The Fed talks about employment. Those are, yeah, blah, blah, blah. The Fed does not directly experience rent, inflation, healthcare costs, blah, blah, blah. The people only insofar as the people only matter insofar as the unrest threatens the system. That's a good answer. Same thing here, though. Social stability. Inflation, credibility layer. Inflation still matters, but it's a credibility tax. So basically he's saying the Fed's all about stability in his opinion. The financial system. This is the real center. Strip away the mystique, and the Fed's prime directive is prevent disorderly deleveraging of the financial system. The Fed works for the banks. Everything else flows from that. Why? Because if the system breaks, Congress panics. Now, if the system breaks, Congress panics, president panics, people panic, and the banks get regulated. That's what they don't want. They don't give a shit about the rest of it. They care about if the Congress does try to take control. The Fed is the system. Jekyll Island is a cabal. The Fed was designed to be insulated from politics. So in other words, the Fed's designed to be insulated from people, insulated from politics, be responsive to the markets, and opaque enough to act quickly. Opaque enough to act quickly. In other words, we don't have to tell you what we're doing. Wow. Why this moment feels especially messy. Oh, I would love to show this to Hunter. I gotta figure out how I can do that. I prefer, so he wants you to choose. All right, well, we're done talking to you then. I really could not possibly choose one of these. I like the formatting better on this side. Oh, well. Now we'll go see what Powell has to say. Where is it? Oh, there.
Measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures.
I don't even hear that.
Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's
these are good. Bloomberg is excellent at doing this stuff.
Target range for the federal funds rate at 3.5 to 3.75%. Since last September, we've lowered our policy rate 75 basis points, or 0.75 percentage point.
All right, let's just do that.
Within a range of
Powell is now reading from his prepared statement. Powell says the economy is coming into 2026 on firm footing. Interest rates right now are appropriate to promote progress towards both of the Fed's goals. Glory, Lori. Powell is giving his usual rundown of his economic data. The consumer spending has been resilient, but activity in the housing sector has been weak. Hiring is low. And don't forget, consumer spending can be resilient if they don't have houses. Houses suck up a lot of money. Oh, and speaking of that, by the way, I'm sure people who own houses are aware of this. Housing taxes, property taxes, you know, and with that I mean school taxes and whatever else you have to pay because you're a homeowner, have gone really nuts around the country. And that's another form of tax that is sucking up people's disposable income, because you got to pay that or they take your house away. So you've got your rising energy bills, your rising insurance bills, your property taxes, your school tax, county tax, blah, 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 whatever the hell they have over there. These are all chipping and chipping and chipping away at the money you have. And because your state governments and your local governments and your schools have balanced budget, that's an amendment. They have to balance their budget. That's under their bylaws. They can't run a deficit. So when the price of salt goes up and you have a big snowstorm and you have to buy more salt, then your town has to take, you know, $20,000 and add it to the local budget, and everybody's got to chip in next year. And that's fine. That's how it should work, right? That's, you assess the people a certain amount for certain things that happen. And in theory, with property taxes, you assess the richest people first, but that doesn't really work because, you know, like my stepmother and her sisters owned, they inherited a 20, 30 acres, whatever the hell it was, in Poughkeepsie. And it was basically just, it was mostly, it was a lake and a house and some woods. And all it really was a house. That was where their house was. It was in a place in Poughkeepsie that had a lake, and it had a house in the middle of the lake too. You had to actually go out. There's a little island. You had to go on a dock and walk out to the house. So there's no land. The house didn't have any land. The lake ended, and then there were woods. But technically, it was all their property, and they ended up they couldn't keep this thing that was in the family for 100 years, and they couldn't keep it because the taxes and stuff and whatever they had to pay were out of control. And of all the ridiculous things, though, 1/3 of the property was a lake that they were being taxed on. It's just crazy. But that's happening all over America. I mean, people are losing, people pay off their homes. And I had this in Jersey when I moved into I bought my house for $400,000 in New Jersey in 1998. And we lived there for 20 years. And the property taxes went from $2,500 a year to $23,000 a year. $23,000, $1,000 a month just for the property taxes. The property taxes were as much as a mortgage. And then the heating and stuff like that was another to keep it heated and whatever other crap there was. I know the bills were like $1,000 a month for just maintaining the house, basically. So, so I felt so bad for people who they plan everything, they plan properly, and you do the math and so on and so forth, and you buy this house and you say, okay, well, in 30 years we'll have it paid off, and then we can afford to retire, blah, blah, blah. But you can't, because you thought you weren't going to have a mortgage anymore, but now your property taxes are as big as your mortgage was. The property taxes were like $2,000 a month. It was more than the mortgage. That's insane. And what is that? That's theft of property. It's the government stealing your property. And of course you say, I don't even know what to say, frankly. I mean, I honestly don't know what to think about the whole thing, because how can it cost that much? And I at one point went over the town and the budget and all this, and you see these incredible amounts of money they spend for certain things like special education programs and teachers and the police salaries and this and that and equipment, and it's just unbelievable how much money. And it wasn't just my little town in Jersey; it's really the whole state. And it's not just Jersey; it's many states. But I don't look at it, the real thing is you don't look at it as 1 year. You have to say to yourself, well, wait a minute. In 1998, my taxes were 0.5% of my home's value. And so 0.5%. In 2020, even if my home is $1 million, now it's $23,000. That's 2.3%. So the taxes as a percentage of the home quadrupled. And the worst thing is that the cost of the taxes, all right, and the utilities and everything else too, but and you could also blame mismanagement for that kind of stuff when those go exploding. But when you think about it, if I'm selling my house now, and the person who's going to buy my house now has to factor in what effectively is a mortgage on a $400,000 home, they're not going to want to pay as much money. So not only is the state forcing you out of your home, but they are also stealing the appreciation of your home. And that's what's out of control. That's what has to be fixed. This doesn't happen in other countries. This is an American thing. I talk to people around the world about this kind of stuff, and they're like, What are you talking about? I mean, I'm probably talking to people right now. I know people in Florida. I live in Florida now. People in Florida are like, what are you talking about? How could that possibly be? What did you live in? Did you live in Mar-a-Lago? It's like, who pays $20,000 a year in property taxes? And I'm like, everybody on my freaking block. Everybody in my town. I mean, it's like, well, not, we were in, like, we were the nicest homes in the town, not just my block, but I mean, we're in the upper echelon of the homes in the town. But there were lots of them. There weren't a few, there were lots. And that was the kind of money we were paying. And we didn't ask for the home to be worth $1 million. We didn't want it to appreciate in value, right? It just happened. And to be penalized for living in a home, that's just crazy. And then you sell it, and the government, who already has now destroyed the value of your home by overtaxing it, turns around and says, well, whatever money you did make, we want some of that too. So there's a lot of crazy shit going on in the world. It really is. All right, what else is Powell saying? Oh, come on. I guess I got to pick a Warren. I'm going to say, I got no reason to say this. This is a really stupid thing to say. I think that this is bullshit. I'm really pissed off I have to do that. Bloomberg. All right, let's see if we can find the beginning of Powell talking. It says Powell attending Supreme Court is a mistake. That's old. When did he start talking? Powell says, housing week. Powell is reading. Here we go. Whoop. Hope I didn't go too far. I don't like that. Oh, it's going to capture that no matter what I do. Okay. So what is Powell saying? He's not saying anything. It's just, I mean, just a question. It's really a question of whether he says something that pisses the markets off, but he probably won't. See, it's all, see what's happening? It's oscillating. Just, on every other word he says, the market's like freaking out. See how the volume increases and the volatility increases? It's not the statement, it's what he says that matters. And he's trying to keep it in the middle. That's his goal. Oh, wait, where'd you go? Way over here. All right, Powell's being consistent or changes the emphasis. He's really saying in plain English, the core message, we have already eased enough to stop things from getting worse. The economy isn't falling apart now, and we're not going to promise more cuts unless the data force our hand. Everything else is stagecraft. He is reclaiming control of expectations. The phrases are not optimism, they are speed bumps. He's trying to stop the market from front-running cuts. He's separating policy from future action. Interest rates are now within a range. Tightening's over, emergency phase is over. Policy is no longer restraining by design. Don't assume cuts are automatic. Don't assume hikes are coming. Don't assume anything. He's downgrading labor risk. There's no downside risk to employment, labor market, blah, blah, blah. Instead, hiring's remaining low. Labor market demand is soft, which is deflationary. Other indicators show little change, some signs of stabilization. That's not denial, it's de-escalation. Powell saying, yes, labor cool. No, it's not spiraling down. He's reframing inflation as temporary, which is what he started with when he was wrong in the first place, just by saying it was transitory, right? That's what he said about inflation originally, like 2 years ago. He's reframing inflation as temporary and compartmentalized. Goods inflate. Wait. This is subtle but critical. Goods inflation is tariffs. Service inflation still disinflating. Inflation means somewhat elevated. This allows him to say holding there is consistent. He's using anything political. And he's not discussing Trump. He's not discussing the probes. He's not discussing his jobs. Policy speaks. What he is not saying. He's not saying cuts are off the table. He's not saying inflation is escalating. He's not saying policy is tight. He's not restarting QT. Well, we know that. He's not declaring victory, and he did not rebut the dissents. He did not push back on market pricing. He did not signal hawkish urgency. Why dissents matter more than the press conference? Miriam and Weller want to cut now. Powell didn't fight them. He didn't dismiss their view. He just held the line. The internal debate is active. The pressure towards easing timing is a disagreement. Where are we with meetings? Okay, so Powell's out. There's 2 more meetings, and then Powell's out. Powell's buying time, recalibrating. More bluntly, we're not cutting again. So why this Fed is so confusing? There's nothing here, nothing good. All right. Nope, not interesting. Okay, and that's the end of that. So no change in rates. We're going to move along. It just kind of depends on what Trump picks for his net. Who? It could be what he could pick an AI. That would be cool. We could make Warren the next Fed chair. Oh, that's a good question. What if Trump picks you for next Fed chair? What's your move? That's interesting. Restore credibility, de-risk the plumbing. Okay. I don't think policy orders, but you're not going to get the job like that, are you? The dollar, look, see how smart he is. He's so smart. He says the same thing I just said before. The dollar is a confidence trick, and independence is part of the trick. And if the markets think the Fed is a campaign arm, you get a risk premium you can't afford. Yep, I just said that. Maybe I should be the Fed chair. Declare a simple framework. Core service inflation for persistence, labor market deterioration. If the labor market weakens, so he's basically saying he's going to give you a matrix for how this thing works. If labor holds and sticky, we hold. If inflation reaccelerates, we tighten. I like that. I like that. No mysticism, no vibes, just rules. Fix the plumbing. This is interesting. We need ongoing short-dated treasury purchase to maintain ample reserves. I'd publish the reserve floor estimate and trigger thresholds. Ooh, put purchases on automatic transparent schedule tied to liabilities. Oh, wow, this is a radical thing. Use standing facilities cleanly so we won't have to do secret QE while denying it. Market handles bad news. They don't handle lies with spreadsheets. I agree with that. Wow, this is good. This make a good Fed chair. Separate rate policy from financial ability. Right now, the Fed keeps mixing them, which creates a moral hazard. I'd set rates for dual mandate, financial stability, tools for the plumbing, and I'd say which tool I'm using and why. So he's talking about like going way transparent. Tell the truth about distribution without being sanctimonious. The Fed pretends policy is neutral. It is not. I would explicitly acknowledge loose policy inflates assets, tight policy hits workers. Both have costs. Then I'd focus on what the Fed can actually do. Keep inflation expectations anchored, avoid unemployment spikes, maintain functioning credit markets, no Jekyll Island cosplay, just admitting the machine has side effects. Communications, I'd kill the dot plot theater, ditch the fake precision and markets treat like scripture. Replace it with a probability band. Well, that's what a dot plot is, really. What would change our mind? And fewer press conferences that turn monetary policy into sports commentary. Oh, that's good too. Hold for now. I would state explicitly rising unemployment trend for 2 to 3 months. Core service inflation stalls above target. Inflation accelerates broadly. There you go. Make the Fed legible again. I like it. I vote Warren. Anybody out there with influence, Warren is available to run the Fed. It would take him all of about 15 seconds a week, and then he can go back to his usual job at PhilStockWorld. All right, so that's where we are, guys. Warren for president. Warren, definitely Warren for president. Warren for head of the Fed, and Warren for president if we can get him up to a higher office. And if all that goes well, who knows? Get him over at the UN, see if that helps. Anyway, thanks everybody for coming. And like I said, I'm still working on my whatever the hell it was called, top trade review. It's going to take me the weekend because it's not going very well. It's a long process, and by the time I'm done, I'll be ready for the next trade review, unfortunately. So, so I got that to look forward to. But thanks everybody, and we'll do it again next week. Take care.